All right, so now we're going to talk about the stock market. And if you recognize this image, so what is a stock? A share of stock represents a partial ownership of a firm. So stockholders or shareholders have a claim on the company's assets and future profits, unlike bondholders. An interesting question has come up in the last few decades about this rise in what we call shareholder capitalism, in which companies, publicly held companies, which means they sell stock to the public, their ownership is available to the public, unlike privately held firms, which are not available to the public. This shareholder capitalism for publicly traded companies, which comes from some changes in the laws and changes in the way that corporate CEOs and other management officials are compensated. More often now they're compensated in shares of stock, has made it so that the focus on stock price, which is a function of the profitability of the firm usually, is tantamount. And this means that firms are perhaps gearing up to make sure their short-run profit is higher, so that their shareholders are more rewarded, right? Because if you own a stock of a company, the way you make money, the two ways you make money are either through dividends, right? Each shareholder gets a dividend. The firm can decide how much of the profits that they reinvest into their own company, or that's retained earnings, or give to the shareholders in the form of dividends. And so the profitability of the firm and the shareholder price becomes tantamount, right? So to jack up your shareholder price, you jack up your profitability. And of course, there's a couple ways to pump up your profitability. One is to pay workers less. This could be a reason why we have wage stagnation in the U.S. for the last few decades. And another way to do it is to not reinvest those profits into your company, but rather put them out as dividend profits. So is it worth it? What you're looking at here is a graph from The Economist about how much reinvestment is being done. And clearly since about 1970, firms are on the decline. So they're choosing rather to distribute cash to their dividend holders. Pardon me. They're choosing instead to disperse cash to their shareholders. And the question for the firm and for the economy as a whole, to which that firm belongs, is does this come at the expense of long-run growth? Fine question. But we'll leave it there for now. So what do stocks do? Let's get back to the basics. Stocks are part of the financial system, the infrastructure of the economy. They channel funds from savers to investors. They spread risk, and they reallocate control. The stock market is where these publicly traded stocks are bought and sold. And these are used or existing stock. They're not first-time sales. So you can see the floor of the New York Stock Exchange on the right, and you can see a stock trader on the left. Used to be a lot more people involved. Now there's a lot more computers involved. And if you're interested more in this, check out Michael Lewis. He's got some interesting takes on the stock market and what it's become. So for a firm to sell the first time, to release stock for the first time, it's called an initial public offering, or an IPO. Not to be confused with IPA. So that's the first time a stock is sold to the public. And they can get a lot of press. So let's compare stocks and bonds. We've talked about bonds. They're lending instruments. They've got specific future interest payments. Stocks are a little more uncertain. There's probably more risk in stocks, uncertain future dividends. For bonds, you're first in line to get paid if the company goes bankrupt, but if you're a stockholder, you're last in line. And if you're a bondholder, you have no rights to help control the company, but a stockholder does, because they are part shareholder. So you can see the pros and cons of each and why people choose to be bond heavy if they're less risk tolerant, and stock heavy in their portfolios if they're more risk tolerant. And you can see here what it looks like when you're looking at stock market data. For instance, if you're looking at the Wall Street Journal, you look at the stock price, the stock name, what the name shows up on the ticker, and you can see the performance of the stock price, the opening price, the high price, the low price, the market cap rate, the price to earnings ratio, P/E ratio, the dividend yield, different ways to measure the value of the stock. And you can see today how much it's changed. Another large question for you to consider: do you think stock prices are rational? What would be the arguments for and against? You're looking at the S&P 500, a large stock market index in the US, and you're looking at the years, I think 1927 to current May 2020. So the vertical bars are always recessions. Whenever you see macroeconomic data like this, you're looking at recessions. So come up with one or two reasons why this looks rational to you, and one or two reasons why there may be some irrationality built in. One question I would ask myself if I were looking for evidence of irrationality is before the financial crisis. So you're looking at the years leading up to 2008, when a lot of wealth was being built up in real estate and then came crashing down. Did anything underlying in the economy change to make that crash? No. And again, for more on what happened in the financial crisis, we're looking in our class at the Inside Job, but there's a wonderful set of documentaries from PBS Frontline called Inside the Meltdown, which goes into more detail. And there are other videos about it as well. So that's a question that we'll leave for another time, but it's an important question. And to review the stock market, like banks and the bond market, the stock market also channels funds from savers to investors and spreads risk. However, the stock market is different than the bond market in that shareholders have a say in how the company is run. And finally, the difference between bonds and stocks comes down to the difference between lending money to a company and owning part of that company. All right, so nobody joined my dance party the other day, but if you need a little bit of movement, let me give you a little bit of movement. Inhale, stretch up. Hold your breath at the top. Exhale. Stretch over to one side. Stretch over to the other side. Shake out your wrists, right? Doing a lot of typing. Shake out your shoulders, maybe circle to the back, circle to the front. Grab behind you, interlace your fingers. Reach up with your chest and your chin, lifting up your wrists. And do a quick floss.